But let's go broader. Samir Arora joining in. He's founder and fund manager at Helios Capital. Now, this is that time of the year where you need to start looking a little bit of a rewind, and I would suppose a lot of forward looking. Samir, thank you so much for coming in. I mean, it's been an exciting year for you as well. Helios has done really well through the year, so that has been great, and it seems to be survival mode when it comes to how the markets have gone through so much going on, right? From trade attacks to concerns geopolitically and all of that in our stride.
So, if you look at, of course, Helios has done well, and, our assets have crossed 8,000 crores, which we thought might take, many more quarters. So that part is good. But if you look at the market, after a lot of ups and downs, including the war with Pakistan and the trade war with US and all that, at the end of the year, the market has done badly only if you do a relative comparison with other markets. If you look at it with itself as in, just a market going up 5-6%, it is bad, but not end of the world bad. If you also take into account that the previous 2 years were very, very good. Normally, at any time, if somebody said, how much can a market fall in a bad time, we would say 10-15% without batting an eyelid. And now it is actually up 5-6% if you look at the broader market, and maybe 10% for Nifty. So it's not bad, but it looks bad because all this effort has been put in for this, while the other markets are rocking and up 30-40%, particularly emerging markets.
I think that's really the question. Abhi aur kya kare? If you
कुछ नहीं करना होता.
No, I mean,
from the point. Your time.
No, let me complete what I'm trying to say. The RBI, by all accounts, and everyone would agree, has given exactly what the street needs. Right?
Correct.
Government has eased taxes, GST, consumption boost, PLI scheme. It's all the boxes have been checked. So from that point of view, what else now?
No, I don't think. I think the market has to go up for 15 days for whatever independent reason. And then the foreigners will come in, and then all these reasons will be used to justify from there on. But that you need something, God knows what. But these things happen. I never buy value stocks. I am this growth guy. But about a year and a half ago, I bought Alibaba in my global fund, saying it's too cheap, man. It is doing well. It'll go up on its own someday. And then I still don't know why it started going up. Of course, the whole Chinese market started going up. So I believe that we are doing a good job, and relatively we have paid our dues to whoever was worried that India was outperforming every day for 2-3 years. And many things have happened on the ground. So it's a matter of time. As long as you are not, while waiting, separately bleeding to death, it's okay. It's not that all these guys, even our fund or 90% of the Indian public could have invested in Korea. So you can feel bad that, okay, Korea is up 60%, but we are up 6%. But relatively speaking, you couldn't have done much more with that. Even if you had put it in a bank account or debt fund, you would have done worse. So it is painful, but it's not the kind of pain we have seen in our life. So it's broadly okay. But the prospects for next year on both relative and absolute look good. Actually, if you look at it from October, India is already relatively doing better than other markets. Not every market, but at least better than the aggregate emerging market index, Chinese index, and even US, even NASDAQ. And this is when I'm looking at MSCI in dollar terms.
Yeah.
So India has not done badly in recent days. And by the way, it is also not done badly if you start from March.
Yeah. I was just going to come to that. Samir, good morning. Alex here. So it depends on the lens through which you look at it in the time frame. If you go back to some 4-5 years, then that period of outperformance, if you remove the last 1 year, has been absolutely frenetic, right? So having said that,
even if you include the last year.
Even if you include the last year. So the argument that is being made is that you cannot do too much on the multiple side. So what has to move is the earnings side. So the question to you, therefore, is how many pockets are you seeing that outperformance take place heading into the end of next year? And comfortably, you can say that in FY27 that will take place.
Yeah. So first thing is that in aggregate this year the earnings will be lower because the financial sector, that is the banks, have got lower, and also the IT, and also because this consumer GST cuts and all these cuts are now feeding through and may take some time, including interest rate cuts. So this year the aggregate earnings growth will be 10-12%, and that is where the market is headed in terms of an annual number. But if you look at the estimates from 27 March, that means starting April 1, 26, very easily they will be 15% plus as they have been in the past. Actually, think that Kotak, which is supposedly the more bearish guy on the street, has an 18% number for 27 over 26. And that is because of all these things taking time, whether it's interest rate cut or GST cut and all that feeding through, and also the spate of downgrades that happened this year in IT and other things may bottom out. So overall, even if it's not 18, if it is back to 13, 15, that is our longer term range, and that is the longer term index expectations. This year, index expectations were low, and they have and returns from index, that is 500 index, were low, and they have been in that range. So it is still not out of line with its broad earnings on a year-to-year kind basis.
Okay, so therefore, and this comes to the crux of it, Samir. From the perspective of the investor, ultimately she wants to see the returns. From that lens, do you anticipate that FY27 from a stock picking and return perspective will be significantly better?
So yeah, I think they'll be significantly better, but the returns that you got from 20 to 23 or 24 in 1 year was bad in between, I think 22. But those returns are also not normal in that sense. The returns, if you do 10-year, 15-year, 20-year type, have been broadly in the range of 13 to 15% per annum. And that is in line with our corporate earnings growth in general and the nominal GDP growth plus 2-3% in the past. Now, this year, the nominal GDP growth is less, and therefore the top line looks less. And also, the second thing is that you have to compare your returns with the alternative, which for the equity market guys is broadly benchmark is debt. And for debt, the benchmark or the thumb rule is to compare it to 10-year bond. And that spread is 5-6% per annum, not every year, but broadly over any 4-5 year period. And therefore, it's all in line with that. I'm telling you, this year is, if you say after 2 good years that you'll make 6-7% and not lose 10%, generally it's not bad. It is just that it looks that India has been isolated, that we were given this extra tariff of 25% and the rest of the world is rocking, and that part we have to overcome, and this is the cost of this tariff that was put on us, and the fact that we had a war and all that, which changed some geopolitical relationships with US and others.
Samir, good morning, or is it afternoon already?
It's sort of morning only.
Morning only. Okay, great. Samir, so if just tying in back to what you said, that the most bearish guy is looking at 18% earnings growth, so on and so forth, you would have your own assessment too. You've launched a small cap fund, right? Would you believe that a larger, broader earnings growth could reverse this whole lull or the downtrend that we have in the mid space for calendar year 26? Is it possible?
So first thing is that if that's what I keep saying, that if you look at this year, it looks that this year the market is down, and it is on the way down because people are getting more and more upset or whatever. But if you look at it from March, it is not like that. From March, the mid cap index is up 24-25%. From March, I think the small cap index is up 18-20%. It is that what happened between September and March, we are not forgetting. And also, as a market, we have not overcome. But if you look at the trend, it changed not now, it has changed many months ago. If you look at it in relative, it changed 2 months ago. If you look at it in absolute, it changed from March. But still, it is down year to date 5-6%. That is the small cap index. So our thinking is, which is different from some of the guys who feel that large caps will outperform. We think that if large caps consistently perform, little bit, not have to perform big, then there will be a lot more interest in mid and small cap. And one reason for that is that the definition of small cap in India has become very big. And the definition of large companies has become very small. That means only 100 companies are large cap, whereas all the action, all the IPOs, all the new growth is happening in mid cap, maybe not in small cap.
Yeah.
But therefore, a combo of mid and small gives that extra kicker over the very sort of boring large cap growth, which might be consistent, but it is boring.
It is, it is. Well, maybe at some point of time that definition could, because I mean, the smallest company and the mid-sized company have all expanded in size. Who knows? The definition might change too. What I actually meant, Samir, was that, I mean, since May 15th odd, right, we are at this, let's say, for example, 51,000 level for the BSE small cap. So we may have rallied from March, but since then we're kind of flattish, which is why. So,
Correct.
Yeah.
So if you see what can be the reason, what is the reason for FIIs who were buying in March, April, May, June suddenly becoming negative when they did not become negative on the rest of the world? We have to connect it to something. That something is that in July, of course, the results were a bit ordinary to bad. But July, I think 31st or August 1st was when the tariffs were announced. And these additional tariffs isolated us in the eyes of the world, and also in terms of many big picture macro guys who are not overly bothered that whether this mattered to this or it mattered to that, or these companies are not listed and all that. But it affected the currency, it affected in general sentiment, it affected actually maybe unlisted but smaller companies. It did affect the small universe, if not the small cap listed universe, because of all the exports and all these things happening from smaller companies in textiles and shrimps and carpets and gems and jewelry and all that. And so therefore that is one event which we think at least the additional 25% will go away. India did not sign a very high profile defense deal with Russia, which may have upset the US guys that 4 days later they are doing a deal. India has started buying oil. They have done the deal for gas. And at least that additional 25% did not need any other reason when it was put. So that plus whatever India has done in terms of liquidity and all these cuts and deregulation and in general passage of time means that broadly it will be again maybe around only earnings growth related returns, but earnings growth related returns will be in double digits and mostly will be higher than anything else that you can do in India and most probably in the world also, maybe because the world cannot keep doing like this.
Samir, very quickly before we wrap, what are the nifty returns that you're seeing for 2026 with all of the base?
So in general, all the time we say that the returns for a 1 year out should be in line with earnings. We would think therefore in the mid-teens, which means 14, 15, 15%, let's say as a number.
Okay, that's not a bad number. We'll take that number. Thank you so much, Samir,
Thank you
for speaking with us. Always a pleasure.